Okay, thank you everyone for joining us today. I appreciate you taking the time. I know you're all busy professionals and that you have other things that you could be doing, but I promise this is going to be a good use of your time and you're going to learn something new about what's going on in the market and how we can collectively help our clients mitigate all of the challenges that we're facing right now because of these higher interest rates. So just a general overview, we're going to be talking about what's going on in the markets right now. Obviously, it's all over the news, both about prices rising, interest rates rising. We'll talk about where rates are currently and where the industry expectations are as far as where they will be moving over the next few years. We'll talk about why the rise in rates is happening so that you have some context for your clients when you're having these discussions with them. And then we'll have some tactics about how you can help your clients mitigate these challenges. And the goal here being to raise awareness with the clients so that they can more successfully navigate transactions in the current environment, which presents some challenges. And at the end, we'll be doing a Q&A. So if you have questions, please post them in the chat. We will be getting to all of them at the end. So I appreciate if you would post questions as things come up, and we'll make sure that we get to all of them. So first of all, to start, just a general overview. We have people attending today from different capacities of helping clients. So we have financial advisors, we have business managers, and a lot of real estate agents. So we're going to talk about it from a general advisor perspective, but obviously this will apply differently to different people. So just to give an overview on the market, what's happening right now, interest rates obviously have risen significantly since the beginning of the year. It seems like January 1, something clicked and all of a sudden rates are moving up and moving up quickly. What's presenting itself now is still very much a seller's market where the inventory is still very constrained of new homes. We just haven't built enough new homes, partly because of the pandemic, partly because of the fallout from the financial crisis back in 2007, 2008, but there just simply isn't enough housing to meet the demand. The fortunate thing for property values is that is actually keeping prices at the moment from declining, because at some point, once you make affordability less attractive for a buyer, at some point, every buyer will have a breaking point where they'll just say, I can't pay this price and pay a higher mortgage rate. And at some point that time may come. Obviously, it'll affect different markets differently. We have a national audience on this call today. So we're going to talk about it more broadly because every market that we service, and we're licensed in 35 states, but every single one of them is unique and seeing different things, similar trends, but different ways that this is playing out. So it just becomes a situation where we try to mitigate these challenges for clients so that they can go into these transactions with confidence and feeling like they're ready to go and they know what they're expecting, and also raising some ideas to them that may help make the transaction more successful for them. So where are rates currently? So if we look at Fannie Mae as a benchmark, I know a lot of the agents joining the call today are in markets where jumbo loans are much more prevalent than Fannie Mae loans, but using Fannie Mae as a benchmark, those rates on basically December 31st were at or below 3%. Those are now firmly into the fives, probably mid fives on average. And for a client that may not have a perfect credit profile, we may be close to touching 6. So we're seeing these rates almost doubling in a matter of about 4 months, which is a very insane, fast pace. We're seeing jumbo rates probably in the 4s, maybe the upper half of the 4s. And ARM rates are generally in the 3s and the upper 3s into the low 4s on average. Obviously, every client's rate is going to be unique to their situation. But as you can tell, there's a pretty wide spread between fixed rates and ARM rates. And that has a lot to do with what's going on in the economy. Basically, banks are more willing to give lower rates on a loan where they only have to guarantee the rate for a certain period of time. So for example, a 5-year ARM, they only have to commit to that rate for 5 years, and then it can more or less adjust, in line with market rates. So it's less risky from a bank's perspective, but might provide some more risk for the client as far as what happens after that rate adjusts. But we're definitely seeing a much wider spread between a fixed rate and an ARM rate that we haven't seen in a while. And that's generally the reason why. So what we've seen is that ARMs have become 3 times more popular than they were at the end of last year. So 3 times as many transactions clients are taking ARM products, whereas maybe 6 months ago, they might have taken a fixed rate. So, and we'll talk about that a little bit more in detail. But the question is, where are rates heading and how is that potentially going to affect the market? So in my personal opinion, and others may think differently, but if we go back to the industry expectation before the end of the year, I was actually looking at some articles that I thought were pretty relevant. If we look back at what the expectations were, maybe 6 months ago, was that interest rates were likely to go up a little bit and would probably end the year at the end of 2022 somewhere in the ballpark of 3.5% to 4%. That's for a standard 30-year fixed Fannie Mae type of loan, which is typically the industry benchmark that most people use. Obviously, we're well above that already in a much shorter period of time. And so we've far exceeded what the industry is expecting. However, there are inflationary pressures that we'll talk about in more detail that are pushing those rates up. And it seems that that is going to persist for a period of time. So my personal expectation is that we're going to see rates climb a little bit higher, maybe touching 6% on a Fannie Mae loan, which we have not seen in almost 20 years. But over time, in my opinion, again, not everyone's opinion, one of 2 things is likely to happen. Either inflation will get a little more under control. And if so, we've seen historical patterns of consumer interest rates dropping when that happens, or inflation will continue to be a problem to the point where we may enter a recession, which also pushes interest rates down. So we did a recent, I was a panelist on a financial advisor annual event recently, and we polled about 100 financial advisors during that call. And the majority of them agreed with this approach that, which is not a scientific study by any means, it's a small sample, but you get an idea of people who are very in tune with financial matters. The consensus was that interest rates will likely stay at these approximate levels, maybe a little bit higher, but over time, and that's the question mark as to how much time it might take, they may ease and we may see interest rates dip back down a little bit. So that's the hope. I don't think we'll be back into the 2s for a 30-year fix. I think those days are behind us. And it took a global pandemic to get to the point where we would have interest rates that low. So it would take another pretty monumental event, I think, to get them back to that level. So I don't think it's realistic to expect that. But I also don't think it's realistic to go back to the 80s where interest rates were 18%. So I think we're going to moderate a bit. We're going to hit a bit of a plateau with interest rates probably in the next 6 to 12 months, in my opinion. And then we may see it slowly but surely start to inch back down as inflation either gets better or worse. So we'll see if that trend actually transpires. Again, this is not, I don't have a crystal ball. I always say it's in the shop when somebody asks me where exactly things are headed, but it seems like that is the trend that we will likely see. So the question is, why is this happening? Why are interest rates rising so fast? This is not normal. And it's not all, but primarily tied to inflation. So I want to give those who aren't in the financial world a little bit of an overview and understanding for perspective to understand why inflation affects interest rates. So as you know, the Fed has been very active in keeping mortgage rates and general interest rates as low as possible. When you hear about the Fed raising or lowering rates, they are not talking about consumer mortgage rates. It's a very common misconception that, we just had a Fed hike of 0.5%. We got a lot of calls from people that thought that mortgage rates were 0.5% higher the very next day. Not the case. So what they're referring to in that is something called the federal funds rate. So it's basically banks lend each other, or the government lends money to banks on a very short-term basis to just cover funding of different activities. And that interest rate staying low facilitates more lending between companies so that borrowing can become more prevalent and done at cheaper levels. Sounds like a good thing, which it is, because money is cheap and available. And that's what's been happening. And that federal funds rate was at or close to zero for a period of a few years, just about. But what happens is then you have a lot of people borrowing. And sometimes the economy picks up to the point where too much of anything can be a bad thing, right? It can overheat the economy and prices rise on things like gas. Obviously, I'm sure everyone's seen what gas prices are like, certainly not what they were 6 to 12 months ago. Food prices. We have these other supply chain challenges that we're dealing with the war in Ukraine, for example, which is just making the problem from the pandemic even worse, where, for example, you don't have enough new cars. So that means the ones that are available are going to cost more. So all these inflationary pressures are potentially a bad thing because the economy was heating up almost too fast. So what the Fed does is they raise that interim rate to make it a little, to slow lending a little bit, encourage savings, and ultimately trying to bring prices down to a more reasonable level. But that can have an impact, all these things collectively. And again, this is just one reason as to why rates are higher, but it's one of the important ones that can lead to higher mortgage rates. But it's a slippery slope, because as you cool the economy, you take the risk of cooling it too fast, which would lead potentially to a recession, or you don't cool it enough to where your efforts aren't really successful in trying to cool the economy off without, pouring water on it, so to speak. So that inflationary pressure is really what's driving interest rates. And we're all seeing it and feeling it in the cost of just about everything right now. But how it affects mortgage rates, which is the topic of the day, is the important piece here. So what we're seeing as far as how the interest rates are affecting the markets, and we had a great question right when we were starting from a gentleman named Jim. Thank you, Jim, for the question. Here's your cue that this is the point in time where we're going to be talking about your question. So we find that with our clients, I'm sure you experience the same thing, the higher rates affect certain people more than others. And we see that it's usually driven to general price ranges of properties and the types of buyers that are typically buying in those price ranges. So on the lower end, let's say, $500,000 properties, maybe a little higher than that in some markets. But on the lower end, where you're getting an apartment or maybe a really small apartment, if you're in New York City or some other markets, those buyers were, before interest rates went up, there was a segment of those buyers that could only afford it with rates at 3%. So if they're now 5 and approaching 6, you're going to see that some buyers are just not able to afford it. And if you're calling in from New York City and you deal with co-op boards, the same issue persists, where your debt to income ratio may have been 25% 6 months ago. Now you're at 35%, and now the person doesn't qualify for board approval. So the higher rates are definitely going to inch out some of those borderline buyers that could really only make this work if they were doing, a 3% interest rate. So then you have the first-time buyers who are somewhat in that segment, but also very excited and anxious to buy homes, and maybe they're doing well financially. We have found that market is still really strong. The challenge is that those people are having a hard time competing with cash buyers. And because of the low inventory, cash buyers have become very, very prevalent. And usually when you're competing with cash, very difficult when you're putting 20% down to be able to compete with that all cash buyer, because you might need more contingencies, you might need more time. There's some constraints there, which we'll talk about other ways to mitigate as well. But those first time buyers still seem to be very prevalent in the market, and that they have a sense of urgency to buy, because they feel like if rates continue to slip away, it might get to the point where they can't afford it anymore. But they still are in the market, actively searching. We're still in a situation where in the vast majority of markets around the country, that supply is less than demand, and that's what pushes the prices up. Then you have the mid-level buyers, which is different classification as far as dollar amounts for different markets. But what we've found is that those people are not really changing their activity so much. They understand that it's going to cost them more to own that home that they were looking at, but they're generally okay with it up to a certain point. Now, as rates continue to go up, the bar gets higher and higher as far as who fits into that category, but we have not seen a major shift in demand from those mid-level buyers as of yet. And then you have your high-end buyers, let's say, 3+ million, where they have the financial wherewithal to absorb higher interest rates, and they're willing to pay a premium to own a home. And they, maybe have a desire, maybe they have, a new addition to the family, or they want to move to a different neighborhood, and they can afford to do so, even if rates are 5 or 6%. So we have not seen this affect the high end of the market, partly because of the affordability, but also because cash offers are more prevalent in those higher end price ranges. So we don't see that the demand is shifted that much, because if you're not financing, it doesn't really matter where interest rates are, other than how it might eventually start to affect property values, if it does at all. And that comes back to the inventory question again. So some different tactics that you can help your clients consider. And we're not telling you that you need to become a mortgage advisor. That's not the purpose of this call. But we want to provide you with some talking points of what to discuss with your clients, to just raise the flag and say, hey, you might want to talk to your mortgage provider about this specific type of loan or approach or strategy, because it might be a good option for you, depending on where you think rates are. So we talked about how ARM mortgages, adjustable rate mortgages, are more prevalent than ever. And for those of you who may not be perfectly familiar with what an ARM mortgage is and how it works, just to give a 2-second overview, the interest rate, the term ARM, or adjustable rate mortgage, is actually a little misleading, in my opinion, because the interest rate is actually fixed for the first several years of the loan. Okay, but it's at a lower interest rate than what you would typically get on a 30-year fix, because if you think about it again from the bank's perspective, put your banking hat on, usually a bank doesn't want to commit to a really low interest rate for 30 years where they can never change it, but they might be willing to commit to that for 5 years or 7 years or 10 years. So the most common ARM products are a 5, 7, or 10-year ARM, where the interest rate is actually set and does not change for the first 5, 7, or 10 years. So again, we've seen a tripling of demand, according to CNBC, of ARM products in particular. And the reason, in part, is because buyers are trying to bring those payments back down. And so the way to do that is to look at alternative loan products. So if you can get, for example, a 7-year ARM in the high 3s versus a 30-year fixed, around or above 5%, that's a big spread in your monthly payment. And as you go up in loan amount, the interest rate affects your payment more and more. So the more you're borrowing, the more the differential in rates can affect you. But when we talked about the projections of where interest rates may be headed, again, nobody has a crystal ball here, but if they do level off, let's say 3 years from now, we're back down to 3.5% or 4%, for example. Your clients are better off taking an ARM product now if they agree with that approach, that interest rates are likely to decline a bit, because while there is security of knowing that you have a 30-year fixed mortgage, and there are places where a 30-year fix might make sense if a client needs to be ultra conservative, maybe they're approaching retirement, they need to know exactly what their payment's going to be without taking any risk, then a 30-year fix might make sense. But we are having a lot of additional discussions with our clients these days about the choice of loan product. Because when interest rates are at 3% on a 30-year fix, nobody cares. Everyone's just going to take the safe route. So that's why 30-year fixed products were much more prevalent 6 months ago than they're becoming right now. The ARM product allows you to almost roll the clock back a little bit to when rates were a little lower than they are now. So if you can get an ARM product in the high threes versus a fixed in the fives, it's going to make a significant difference. And that affordability factor we've been talking about that may start affecting the market is less prevalent because the mortgage payment is lower as a result. And there is some inherent risk with ARM products because the interest rate can jump after the fixed period of the loan. So after 5, 7, or 10 years, the interest rate can jump. The conversation we're having with clients is that if, for example, you take a 10-year ARM and you have 10 years to allow that interest rate dip to happen, that's a pretty long time. That's usually a typical rate cycle is usually about 7 years. So there is a lot of time in which that rate can go down. So that's one consideration. Obviously, you keep your payments to a minimum. But what people also don't think about is what also happens over the course of 10 years. So first of all, you're saving every single month cumulatively over that first 10 years. Let's say the interest rates do rise, okay, after year 10, and you have an ARM product and you're now in year 11 or year 12, and now the interest rate is higher. It would still potentially be a better choice for you, because if you look at all the savings you had over the first 10 years, it's probably going to still be greater savings than it would by paying a higher interest rate over the first couple of years after the loan starts to adjust. So a 10-year ARM period should kind of be looked at as though it's your best option potentially if you think you're going to hold that loan for maybe 11, 12, 13 years as opposed to just 10, because you have all that accumulated savings, depending on what you do with that money, of course, in the meantime. But you have that accumulated savings. So if you're comparing one to the other, an ARM or a fixed, you want to look at a little bit of an extended period beyond the fixed rate because of the savings that you have over the course of those first 10 years. What people also don't think about is the fact that over 10 years, you hope if somebody's career is advancing over time as they get older and better qualified, their incomes also rise. So you can actually absorb that higher payment better than you could, 10 years prior, because your income is higher. And what we typically do for a client is we would do an analysis of the worst case scenario. So what happens if the rate goes all the way up to the cap, and there are caps on how much the rate can rise. And we do it based on, after the fixed period ends, what's the absolute worst case scenario payment that you could have under any circumstances on this loan. Another thing to consider is that over 10 years, if it's a principal and interest ARM product, the balance on the loan is also going down. Now, interest is front loaded on mortgages, so it's not exactly a third of a 30-year mortgage. If you pay it down for 10 years, it's less than that. But when the payment recalculates after the 10 years in this example, it's based on what the balance is at that given time. So all these factors are things to consider. Again, an ARM product is not for everyone. And some clients are more comfortable with risk than others. But I think with the spread that we've seen between fixed and ARM rates, and the fact that rates may be dipping back down over the next 2, 3, 4, 5 years, as inflation either eases or sends us into a tailspin economically, I think it's worth a discussion. And most clients come to their loan provider and they're just focused on a 30-year fixed, and they don't really have these conversations. In my opinion, they end up with a loan that's not right for them. Because if you refinance, let's say you take a 10-year ARM and you refinance 5 years from now, if you had taken a 30-year fix from the beginning, you will have been paying for security that you didn't need. And you're paying extra every single month. And then once you refinance, you look back and you say, God, I wish I would have taken that 10-year ARM product. So again, every client's risk tolerance is a bit different, but these are deeper discussions that we're having with our clients that I think most mortgage providers probably are not. And that worst case scenario analysis is really enlightening for some, because they realize, gosh, 10 years from now, if I'm not making an extra $1,000 a month compared to what I'm making now to absorb that higher payment, then, something else is wrong, maybe with their employment in general. So the first thing to consider is potentially an ARM product and having an in-depth conversation with someone on the mortgage side that really understands how this works and what the reasons are in favor of or maybe against an ARM product for a specific client. The second option, to roll back the clock a little bit, is using points. So for those that aren't familiar with exactly what this means, we do get this question even from people that say, I think I should know the answer to this question, but what exactly does that mean? What are points? So when you pay points, what you're doing is you are paying an upfront fee, which is basically a one-time added closing cost, in exchange for a lower interest rate over the life of the loan. And in an environment where you're trying to make a property more affordable, or you're trying to stick within a certain budget that maybe you and your financial planner, if you have one, which we hope you do, we're big proponents of that. But to stay within a certain budget, despite the fact that prices are higher right now, points can be a great option, because using the same amount of money that you might use, let's say and this is a tactic that we talk to our clients about a lot. Let's say they're coming to us and saying, I want to put 30% down, right? But the rate's a little higher than what I want. I'm concerned about the monthly payments. What we've recommended to clients to consider is maybe putting a little less down, but allocating some of those funds that they would have used for a larger down payment, and maybe putting, $5,000, $10,000, whatever it is, towards buying that interest rate down, which if you just look at the benefit you get from either putting an extra, let's say $10,000 as a down payment versus reducing the interest rate by 1/4 to 0.5%, you'll see the difference in affordability is much better by using that money for points. So points are a way to bring interest rates down, in essence, basically roll the clock backwards a little bit to when rates were a little bit lower. And you can use that same tactic on fixed or ARM products. And the lower the interest rate you get, then the less likely it is that you're going to refinance, because interest rates have to go lower. If you start at 4% rather than 4.5%, for example, the rate will have to go down at least to maybe 3.5% or thereabouts before it would justify a refinance, as opposed to if you start at 4.5%, it might only have to go down to 4%. So it reduces the likelihood that you might have another transaction, which has additional costs associated with it, and that you might be able to keep that loan as a longer term financing vehicle for you. So there's different considerations there, but points are another tactic that you can use potentially to be able to get those terms. The third thing that I wanted to bring up is that we are having a lot of discussions with our clients about the amount of down payment. And this is something that is really, really critical because it affects the client's long-term financials in general in a very, very significant way. We want to make sure that clients are taking these decisions, making them carefully, because they can have a very long-term effect on the client's financial net worth. So obviously, as you put a larger down payment, it affects the rate exposure. So if you have a higher interest rate, a larger down payment gives you less exposure to higher interest rates, because if you borrow less money, then your mortgage payment is not affected as much by the rates that you have to take. And conversely, if you put a smaller down payment, you are more affected by the interest rates that you get, but you're also keeping funds invested. And as we're looking at different strategies that you can take. And this is one where it's really important. If your clients don't have a financial advisor, this is beyond the scope of what a mortgage lender should typically be advising on. Even though we know what the requirements are of getting the loan, there are differences between what you should put down and what you can put down. Those are two completely different things. So that's where a financial advisor can come in really handy. But these discussions are really important because some clients are coming to us and saying, I was going to put, 20% down, and now I want to put 40% down because interest rates are higher. But the problem with that is that they're now affecting their long-term net worth by doing that. And the interest rates matter less when you look at the bigger picture as far as how much the interest rates might affect you over time. And I'm going to give you some examples here, but one thing to keep in mind, if your clients are looking to buy in all cash, and we'll talk about why, and we'll go through some of these numbers, make sure that they look to finance afterwards, and probably immediately afterwards. You can do that where you can be an all cash buyer so that your bid is ultra competitive, but still be able to take advantage of financing and allowing your investments to compound over time. So there are a few reasons why keeping that money invested and leveraging and borrowing more is important. So first of all, there are on occasion costs of liquidation. So there may be tax implications depending on what price you acquired those investments at and what you're selling it at. You might have capital gains tax, lost appreciation. But the biggest one, in my opinion, is the loss of ability to have those investments compounding in growth over time. Now, granted, this last short stretch hasn't been the greatest as far as what we've been seeing for investments. So it's been a little bit of a tough stretch for investments, but most advisors will tell you, don't look at the short term, look at the bigger picture, long term. And make sure that that everything is factored in there. Sorry, working from home today. There's real life. So that inability to have your assets compounding over time, when you look at compound interest and gains, it really adds up in a very, very significant way. And when you look at those things, it means that the interest that you're paying, even if it is a higher interest rate, and hopefully it'll only be a higher interest rate for a period of time, and then you have the opportunity potentially to refinance. But the gains that you have over time when they compound is much more impactful than the higher interest rate you might be paying or the additional interest you're paying by borrowing more money. So let's give you some examples here. So we did an analysis where we look at a cash buyer in two different price ranges, one at 500,000, one at 2 million, just to give a broader perspective. So we assumed that the investment return is about a 5% rate of return on average over time. I don't think that's an unreasonable expectation. Obviously, there are peaks and valleys, so it's not going to be exact analysis. But a 5% rate of return on investments versus an approximate 4% mortgage rate. Over the course of 10 years, on $500,000 that you could either put as a down payment and take out of investments versus financing, after 10 years, if you finance it, the gains from the investments will be $134,000 greater than the interest that you paid, meaning your net worth grows by $134,000 over 10 years just because you finance rather than buying in cash or putting the extra $500,000 down. If you keep that loan for 20 years, the gain, which again is already factoring in how much interest you've paid during that time to have that mortgage, over 20 years, $518,000 in net worth gained. So you basically double your money just by financing, okay? And then if you look at it over the course of 30 years, I know very few people hold a mortgage or a property for 30 years these days, but just bear with me. Over 30 years, the additional gain beyond paying all the interest on the entire loan of the entire duration of that loan, $1.9 million. Okay, you have quadrupled your money just by financing. Okay, now let's take that same example and look at it over a $2 million transaction where you're either buying in cash for 2 million or you're putting an extra $2 million down beyond what you would actually need to put down. Over 10 years, the additional gain is $530,000 beyond the interest that you paid. That's net worth gained. Over 20 years, it's 2.1 million. So you've doubled your money again in 20 years just by financing. And over 30 years, the gain is almost $8 million. So all these buyers that come into the market and wear a bit of a badge of honor, and I know agents don't want us to discourage people from not buying in cash, which we don't, but we recommend financing afterwards if they need to buy in cash. They are making potentially a horrible financial decision by buying in cash and not financing. And many people don't want to go through the mortgage process for whatever reason. They're not taking financing and looking at it as a great financial move because you don't have mortgage payments. But when you look at compounding interest and you see that over the course of that loan, you're quadrupling your investment just by financing, it can really make a huge difference in a client's net worth. I mean, imagine you look over the course of 30 years, now you're potentially looking at retirement planning and things like that. Imagine if you had an extra $8 million to retire on. That's a huge difference, right? So even though interest rates are higher, and granted, we did this analysis a little bit ago when rates were at 4% or thereabouts, but you might be at a 4% rate, with points or on an ARM or whatever it may be. But these numbers are staggering. And we see people coming in all cash all the time, and our clients are competing with those buyers, and we understand why sellers accept those offers. But if those people aren't financing afterwards, or they're not thinking about the long-term effect of what they're doing and those decisions that they're making, they're missing a huge opportunity. And as advisors, collectively, everybody on this call, it's our job to call these things out, not to tell them what to do, but to say, hey, you may want to have this discussion. And that in and of itself, between the ARMs, the ARM discussion, the points discussion, and the down payment discussion, those are three ways that you can have conversations with your clients that other agents or advisors are not having. And that was the purpose of us talking through all these details today, is to give you the tools, not to necessarily have those conversations with your clients, although if you're a financial advisor, that's a different story. But as an agent, let's say, it wouldn't be probably appropriate for you to be discussing loan products and down payment with your client, other than how it might affect the offer itself. But raising your hand and saying, I know we want to go all cash, but I think you might want to talk to a mortgage provider about what it would mean for you as far as your long-term financial wealth accumulation over time, and maybe talk to a financial advisor about whether that's a good idea to keep that property under leveraged or unleveraged, and really take advantage of playing with the house's money, so to speak, by borrowing money from the bank while allowing your investments to grow over time. So all these points of discussion are things that we think are really important, especially in the current market where affordability is really a challenge. And we're seeing some buyers get that fatigue where they're just like, I'm tuning out. I can't do it anymore. I've lost too many bids, or, for whatever reason, they're getting burnt out on what's happening in the market. So I think one of the really critical things here is that as agents and advisors, you need to strengthen your mortgage partnerships, because if you're recommending people that aren't discussing these things with your clients, they're missing out on opportunities your clients don't even know exist. They're not having these discussions with your average mortgage provider. Most mortgage providers automatically default to a 30-year fixed, and they never have the discussion as far as where rates are going or how to mitigate the times that we're in right now. So strengthening those lender partnerships and really having a higher bar is going to be more critical now than ever, because it might be the difference between whether your client actually wants to proceed with a transaction or not, right? If they don't have these ideas and they're just thinking, oh, I'm not going to pay, 6% interest, so I'm not going to buy, right? We don't want that discussion to overshadow the ways that they might be able to bring those terms down. And now, oh, wait a second, maybe actually, you know what, maybe I can buy now. Thank you for suggesting that. That I talked to my mortgage provider about that. So those are the discussions we wanted to help you initiate with your clients to try to make you a more valued advisor to them. And obviously, we're here to help with those discussions if we're given the opportunity. But you also, current market is that a lot of these buyers have gotten fatigued, especially those that we're putting, let's say, 10 to 20% down. They're perfectly viable buyers, but in the current environment, they're getting beat out over and over and over, and maybe just getting burnt out on the market. Don't ignore those buyers, because if these interest rates do start to affect the market, if we see inventory rise because sellers are starting to see that maybe they can't command the higher prices that they've been commanding, or that you can't always sell the house next door for 10% more than the one next door to it just sold a week ago for. At some point, those buyers are coming back, and they're going to be the bread and butter of the market like they usually are. 20 to 30% down buyers are usually a much more prevalent market segment than they have been over the last 2 to 3 years with these challenges with inventory. So don't neglect those clients, because they're gonna pay your bills as these things materialize. And lastly, this is a shameless plug for all the financial advisors that we work with. If your clients don't have a financial advisor, please recommend that they get one. These are very important discussions. You could literally change their lives financially by getting them in touch with a good financial advisor. And I'm not here to advocate for one in particular, but just the concept of it. We get so many clients who have no financial guidance other than their own preconceived notions, or their depression era parents who told them, pay off your mortgage as fast as you can, take a 10-year loan, pay it off, debt is bad. As we've just shown, in some cases, debt can be used strategically to gain wealth. And there's a different mentality around debt now than there had been with previous generations. And financial advisors are the best equipped of anyone. As much as we like to think we're great advisors, financial advisors have the bigger perspective of being able to plan for retirement and looking at things 30 years ahead of time, because that's part of their role, is to do that. And we are strong advocates that clients have financial advisors, especially as they're making these massive financial decisions that could affect their long-term net worth for the rest of their lives, and what they have to leave to their kids and their grandkids when their days are coming to an end. So we really feel like that's a very, very important aspect of this, and we wish that more clients would have that financial advice. That is probably the most valuable thing. And no matter how much a financial advisor charges, for the most part, it's worth it. So we strongly recommend that you encourage your clients to have them talk to a financial advisor about that as well. So with that, I'm going to turn to the Q&A. Bear with me just a second. Okay, I see. Okay, we see where you're calling in from. San Francisco, great. Okay, so I see a question from Len. Hello, Len, nice to see you. Financial advisor friend, nice to see you. What is the impact on prices based on corporate investing buying single family homes with cash? Yeah, it's we're starting to see more corporate investment in general. And I think BlackRock is very active in that space, where they've been acquiring properties and they've been basically beating out the owner occupants. Because they're all cash, they can close very quickly. So it's definitely created some challenges, but it's also a bit of a risky model if you're buying at peak prices and putting a lot of cash into it. I don't know that is going to continue for all that much longer, but it's definitely affecting the market. It's making the it's making it harder for owner occupants to be able to purchase homes, which is unfortunate. And I have seen some discussion about states that may want to limit that. I know in Canada, there are some rules that that prohibit that or that discourage it or add additional taxes or something to make it less desirable because they don't want prices to continue to go up to where no one can afford to buy because they're up against a BlackRock, for example. So it's definitely a concern and I think a topic of discussion for regulators right now. Okay, let's see. Who else we got here? Okay, Courtney. Hello, Courtney. Would love to discuss the impacts of purchasing power and whether the rates historically would have any effect on purchase price. Not that you have a crystal ball. Well, I don't have a crystal ball. It's in the shop. But yeah, for sure, interest rates affect home prices. There's no question about it. The question is, are the opposing factors, which right now is lack of inventory, are those stronger than the forces of higher interest rates? At the moment, I think they are overall. If we look at the broad general market, and that's why prices are continuing to rise. It's almost like subduction zones where, you get these two tectonic plates that are up against each other. One of them is going to win and end up going up and the other one's going to go down. So at the moment, I think the inventory constraints are more of a problem than the higher interest rates, but we may start seeing, I have heard from some agents that we've started seeing, for example, less offers coming in. Not that there aren't a lot of great offers, but less of them than there were even a month or two ago. So maybe that's a sign of something to come, but it's still a little bit too early to tell. But I think, Courtney, you raised a great question because eventually it will probably affect prices. But at the moment, the inventory constraints are overwhelming that issue. But great question, thank you. Okay, so I see Sia. Thank you, Sia. We are going back to the old days of real estate financing, and our role as real estate advisors will be more important as ever to educate clients on this while working with mortgage advisors and financial advisors and CPAs. This has been so helpful. Thank you. Let's see. Hopefully we can get a recording. You will get a recording. Anyone who is registered for the event is going to get a recording of it today. And I will most certainly use this in my buyer consultation. That's great. That's the exact goal of the session today. So we encourage it. And if there's anything that we can do as a group to help you in those buyer consultations, or if you want to partner up with those clients who may need that advice, please definitely reach out to us. Can you send us the calculations, Oliver or Olivier? Yes, sure. Yeah, we can include that in our email to show you how those numbers pencil out. I think when clients see those numbers, it may be a pretty compelling story. Most people just, they don't really know how to run those numbers, or they don't take them into consideration. But when you see those calculations, it's pretty hard to ignore them. So yeah, I think that's a great idea. We'd be happy to send those out with the link to the recorded session. Okay, Lorna. Hi, Lorna. Great stuff. Please share the charts you prepared for this consultation with us. Absolutely, we will. Once again, a wealth of knowledge. Thank you, Jeff Montana. Okay, Jill, this is a New York, must be from New York City. It's a co-op question. At 35% down in a cooperative apartment at these interest rates, many buyers' debt to income ratio is not good enough to pass a board under these interest rates. I agree. Yeah, we talked about that a little bit. That's one area where the points and the ARMs can be effective. I know some co-op boards are not so keen on shorter term ARM products, or they may have, I've even seen some co-op boards have a different maximum debt to income ratio for ARM products than they do for fixed rates. But it's something that these tactics we talked about can get those people back in contention, potentially. These are all case by case, but it could be something that we can work with you on to try to find a way to get that client back to being a viable co-op buyer all over again. Okay, great. Comment from my friend Joe. Hello, Joe. Joe N. Very informative and relevant with housing market trends in New York City. Thanks, Mark. Thank you. Um, great info. Hello. And thank you. Okay, so I think that concludes our session today. Okay, one last question that just came in from Bruce. Hi, Bruce. Please review the tax deduction when financing after a cash purchase. Okay, that's an important one. Definitely something that we talk about with our clients. So in the event that your client takes the cash out after they've completed an all cash purchase, there are deadlines from an IRS perspective. They have to fund that loan within a certain window of time. I believe it's 90 days if I'm not mistaken, but that would be something that we can confirm with an accountant. Maybe there's one on the call today who wants to post that in the chat. I believe it's 90 days that you have before that interest is no longer tax deductible. Now, when you're talking about tax deductibility of mortgage interest, the newest tax plan can play into that because there are SALT deduction limitations that you have. Some people hit the alternative minimum tax and might not be able to deduct it in the same way. And the standard deductions are now set higher than they were in the past, to where it might not make sense to itemize your deductions, where you might get those direct write-offs from the mortgage interest. So obviously you want to consult your tax advisor as you're discussing that. But you do have to be careful. There is a very definite window of time. Again, I believe it's 90 days to where you have to pull that money out. And if you don't meet that deadline, then that interest is no longer tax deductible for the life of that loan. So it's definitely a great point to bring up. So thank you. Most co-ops will not let cash buyer refinance in the first year or two. So it's a bit tricky in New York City. Yeah. Again, every building and every situation is different. So in the event that you can't finance right away, if the co-op board doesn't allow it, then that's a point of discussion. Then you have to ask yourself, should you be an all cash buyer or not? Or should you make an offer that says, I will buy in cash if I can't get the financing, or if I can't get the financing by a certain time? But still, that might be a reason to have that discussion with your client. Say, I know we want to go in all cash, but if you can't finance for 1 to 2 years, then, and you might not get that tax deduction, which was a great thing to bring up, Bruce, then that's a discussion you want to have with your client up front before they commit to being all cash, because maybe they're going to walk away from, potentially millions of dollars of long-term net worth by not having that discussion up front. So there you go. There's a perfect example of why this webinar was done today, was to bring all this to your attention so that you can have those intelligent conversations with your client, because there are unique circumstances like Susan mentioned here, where you might not be able to take it out for reasons that are out of your control. Co-ops are a unique animal to New York City, but they do have restrictions on certain things. So those are things that you want to be mindful of. And this is, Susan, I couldn't thank you enough for mentioning that, because it just gives a little more credibility to why we're all here today. So thank you for doing that. I don't see any other questions, just some thank yous. Hello, Bill. Nice to see you. Bill helped me buy this house that I'm in right now. So nice to see you, Bill, and some other, lots of other familiar faces. So I really appreciate everyone joining. That's going to be a wrap for us. I would say definitely keep in touch. I'm going to put up a screen that will have our team's contact information. So in the event that you want to reach out to us and talk to us about being a mortgage provider who can add this value, we like to think we do what we call a higher level of lending. And what you've seen today is one indication of that, where we're having deeper conversations with our clients, understanding what's going on in the market, and actually taking action in our discussions with those clients, and making sure they have proper representation as far as financial advice, which comes in part from us, but we are limited to guiding on the mortgage side. And that's why we're such proponents of the financial advisor partnerships. So I really appreciate everybody coming today. I'll leave this up, and we will be sending out that recorded version, and a couple requests came for those numbers that we talked about. So we'll include that as well. And thank you all so much for joining us today, and take care and keep in touch.